What's up, everyone? In today's video, I'm going to be going over A to Z trading psychology. So I could have made all of the topics that I'm going to be talking about today, I could have made all of these into 10 separate videos. But in my opinion, that's just not what I want to do here. I want to make sure that you guys know right now in one video every single thing that you pretty much need to know about trading psychology and how important it is, and just to learn a little bit more about how trading psychology plays into trading, right? So today's video, A to Z trading psychology. So, intro to trading psychology. So if you've ever traded live funds, ever, doesn't matter how much you traded with, $500 or $20,000, these are definitely going to be some of the problems that you have faced. Have you ever become aggressive after losing money? Do you get scared of taking trades after losing money? Do you hold losers hoping that they will turn around? You exit winning trades too early. You ignore your trading plan. You don't pull the trigger on a solid setup. You tend to give all your profits back in one trade. You allow one good or bad trading day to dictate how you feel. If you have ever felt any of these, then you need to pay attention to the rest of this video, because you should not be, after a certain point, once you get good enough and once you train your brain enough, you should not be holding on to losers hoping that they will turn around. You shouldn't be allowing one good or bad trading day to dictate how you feel. Okay? So now, next slide. We, as humans, are not built to trade, right? Humans are only built for survival. We will do whatever we can to feel good and safe, even if that hurts us. In this case, trading, right? We will take a bad trade just to feel some dopamine, just to make ourselves happy and not sad, right? This is totally, outside of trading. Just to feel some dopamine. Could care less about the money, but just to feel some dopamine, right? As humans, we want to control the outcome, right? That's what anxiety is, guys. That's what anxiety is. Not knowing the future, worrying about the future, right? How many times would you have a class presentation slideshow that you'd have to do on Friday, and it's Monday, and when you walk into that class, you're already worried about it, and then same thing Tuesday, Wednesday, Thursday, but then once you're 2 minutes into it on Friday, it's no big deal, because now you know how it's going, right? You're not thinking about how it's going to go. You don't not know anything about, in this case, the slideshow, right? The outcome. And as humans, we just don't know the outcome, and we're not apt to deal with that, right? In trading, you have to be 100% okay with not knowing the outcome, right? And being very, very uncertain about what's going to happen in the future. And we view uncertainty as danger, right? And survival is priority. Now, again, saying stuff like survival is priority, okay, it doesn't have to be that deep, right? Like, trading, you're not going to die doing it, okay? But what I'm just trying to say is that, just your brain is just not apt for something like trading. Just default, we're not able to become successful traders without having to train our brain to, get into the trading brain mindset, right? And there's a thing called the amygdala in our brain that causes you to fail at trading. It's responsible for the fight, flight, and freeze, and triggers pleasure when you win and pain and anger when you lose, right? So if you've ever taken a nice winning trade, it feels great, right? But if you've taken a bad losing trade, it feels horrible. You're probably cursing at your screen and slamming your keyboard and stuff like that, right? And saying, "Oh, I'm never gonna trade again. I hate trading." And again, right, a professional trader would just realize it's literally one trade, and it's a game of probabilities. I don't know the exact outcome, but it just gotta play the game if you want to win and be able to trade. And again, that's why you have to stick with trading for long enough to train your brain to be able to be okay with uncertainty and not knowing the outcome, right? So how do we train ourselves to get into the S-tier trading mindset, which is basically just the professional trader's mindset? So how do we train our brain for trading? First off, plan before you enter a trade. Define your risk, position size, setup, and many other things. But just in this case, define risk, position size, and setup is at least what you should be doing, right? If you don't have any plan, before you enter a trade, what are you doing? You should not be taking that trade at all, right? And that's a key component of why people fail at trading, is because they don't have a plan. And if you don't have a plan in trading, you are not going to even come close to succeeding. The second thing, don't look at your P&L. It will totally affect the way that you trade, right? If you see that you're down $200 and your paycheck is, let's say, $200 a day, you're going to start freaking out because, oh my God, I'm down an entire day's worth of work in 3 minutes. But what if you actually look at the chart and realize that, yeah, okay, it went down, but this is a key level of 100, and buyers are coming in defending that zone, and that's the bottom for the day, and then it rallies. Now you would be up 300 if you just held and didn't look at your P&L, right? So that's why it's extremely important. To not look at your P&L. You're looking at your P&L will absolutely affect everything about the trade, right? Red or green. It will absolutely affect the way that you trade. And then third point, take deep breaths when you're in a trade and before the trade. Make sure that you try to stay as calm as possible. Okay? When you get into a trade, when you hit that buy button, you will automatically start to kind of freeze up a little bit, right? It might take a little bit more work to move your mouse around the screen, right? You'll be either not breathing that much or breathing really fast. Your heart will be pumping, it'll be racing like crazy. And it really shouldn't be like that. It will in the beginning, because again, you have to train yourself to not do that automatic response. Everyone does it. You just have to train yourself to not have that automatic response when you do get into a trade, right? You can be looking at the screen, watching price go down like crazy, not caring. The second that you get in, it's exhilarating, right? The second you get in, everything changes. And it really shouldn't be like that, especially if you're sized correctly, you're not over leveraged. It's just one trade, right? And the fourth thing is increase your self-awareness. Know how you feel and get to know yourself, right? Know what triggers you to take a bad trade, right? Does something happen in the morning that you have a coffee and you're just not that focused? Are you on your phone before the market opens, so you're not focused at all? You take a bad trade. You're trying to make exactly $200 a day, right? All this kind of stuff that can externally affect, your trading. And then my last point right here, number 4, is increase your self-awareness. Know how you feel and get to know yourself. It is extremely important that you get to know yourself and know what causes you to take bad trades, right? What does a great trading day look like for you? What routine is that? What mindset are you in? On a bad trading day where you take bad setups, you're not in that S tier trading mindset, what happened that morning, that day, over the course of the market open? What happened that day that caused you to really take a bad trade? It doesn't matter if you win or lose and, the day was fine. But if it's a bad day, just mentally, and you take a bad setup, then that's where you have to start figuring out what's going on, and you have to correct that. So now I'm going to be going over a decent amount of biases and heuristics, and these are different ways our brain views information and how our brain works. So the first one is affect heuristics. It says how we rely on our emotions to make decisions. When you are in a positive emotional state, you look at a trade as high reward, low risk. When you are in a negative emotional state, you look at a trade as low reward, high risk. Right? When I'm in a great mood, I will feel a little bit more like, okay, this is awesome, things are going right. If I do take an L, no big deal. I think I'm going to win every single one of my trades, right? That shouldn't even really be how it is. And the same thing for being in a negative emotional state, where you show up to your computers, oh, I'm just not feeling good, I'm kind of worried about things, and it's like, I don't even want to trade today, right? It's a low reward and high risk. I could lose a bunch of money. I don't really want to put any trades on today. And you shouldn't even be trading when you're feeling happy or sad, right? If you're super euphoric about something or super sad, guys, you should not be trading. Every single trading day, you should literally be starting out flat, right? Start the day out neutral. That is so key, right? Just coming into the market, literally like this, just, okay, let's see what happens today. Not sure what's going to happen, but let's see, right? You should not be feeling overly happy or sad. That is totally going to affect the way that you trade. Now, the next heuristic is the availability heuristic. That says that it's a mental shortcut where people make choices based on how easy and fast they can recall them, right? Let's say that you're trading a double bottom pattern and the last time you longed a double bottom, it failed and you lost money. You don't want to play this setup just because it didn't work the last time. And that's key, right? Because after you take a loss on, let's say, a double bottom, if you see another double bottom on that same day, you would be like, I don't want to play that. I lost on that one earlier today or yesterday or last week. But the thing is that you might have just gotten in too early, right? You might have gotten in here, but that wasn't a double bottom. That's just, basically an H pattern, bearish pattern. Just buyers didn't come in. Price goes all the way down again. And then rallies, gets sold off again. Now here would be the correct double bottom. But you're saying, let's say it goes up. After that, oh, I don't want to long here because I already did that right here and got stopped out here. I don't want to get in another double bottom. But then boom, right? It goes back up. And this might work out 70% of the time. This was just that 30% that it didn't work out, right? But if you take double bottoms, and this is not accurate at all, but if you just take double bottoms, let's say in this scenario, 70% of the time, it'll work out. But that first one was just 30%, right? And this makes sense in real life, but not in trading, right? If a stove is hot, why would you touch it again, right? It's going to hurt you. You don't get any gain from touching the stove again and burning your finger, right? But just because in trading a setup fails, it doesn't mean that it doesn't work at all or that it won't work in the future. And that is so key, right? Just because a setup does not work does not mean that it's never going to work again, right? So dig deeper into why your setups don't work out when they don't work out, right? Here, This might have been 10 o'clock and news came out, and if it was good news, it would have rocketed up, but it was just bad news. And now, the market had to go down a little bit, find some demand, and then it goes back up, right? So dig deeper into why your setups don't work. The next one is representative heuristics. This is a type of mental shortcut where you ignore the probability and attend to the details that align with your potential representations, right? An example of this is you're feeling like only taking bullish trades, right? Just buying, even though the market is telling you it's bearish, right? The market on the daily could be down, 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 and then, it's looking like this, right? It's going to end up on the day like this. It's a bearish day. All you see is just right here. But you're thinking, oh man, yeah, this is totally, I'm only looking to long today. I don't want to go short. When the market is telling you it is extremely bearish, but you only want to do, longs because you feel like longing. No, do not do that. Only the market is always right. If you want to make money, you have to trade with the market, right? Don't try to be a hero and go against it and think that you're a magician and it should listen to you because you want to take long trades. You're nothing. You're one trader in the market, trading one contract, if even that. That it's irrelevant how you feel, okay? And you should be looking at trades from an unbiased point of view, right? If ES gets to 40, 50, then I may long, but I still need to see aggressive buying and positive delta building up and sellers getting absorbed, et cetera, et cetera, et cetera, right? So if this is 40, 50, right? This is 40, 50, and the market is coming down here. You don't just set a limit at 40, 50, stop loss at whatever, 40, 45, and then get filled. What if it gets filled and there's no buyers and you just get stopped out a minute later? No, you need to see how stuff reacts around your key levels, your key zones, and then maybe I'll take a trade. Maybe. You should be getting forced to take trades, right? And you have to really pay attention to what the market wants to do, not how you feel or what side you want to play, right? I see so much of this stuff online about, oh, I'm in a bullish bias, I'm in a bearish bias. You could be in a bullish bias and the market is bloody for the next 3 weeks. That's not going to help you, right? You should be able to start the day out neutral and then develop a bias. Developing a bias outside of market hours is the dumbest thing that you can do, right? So again, don't come into the market with expectations because you want to do X, Y, or Z. Come in neutral and the market will show you what it wants to do, how it reacts off of supply or demand zones, right? Now my next bias, now we're getting into biases, is an anchoring bias. This is the human tendency to rely too much on the first set of info given to them, right? An example of this is probably one of the most well-known ones on here. A car dealer says the price of a car is $25,000. Then the next month he says it's now $30,000 instead of $25,000. You think it's now expensive because the first price that you heard was $25,000. But what if the car is actually worth $40,000 in the first place, you didn't even know, and buying it at $30,000 is still an insane deal, right? Still saving $10,000. Yeah, you could have saved 15, but you're still saving $10,000. But now 30,000 is more expensive compared to 25,000, right? And a trading example of this is thinking that NQ is too expensive to long at 4070 or 14,070 when you were looking at it 3 minutes ago and it was at 1450, even though it's showing massive strength. And it used to be at 1450, now it's at 1470. It's going to be at 14130 later today. But it's too expensive because it was just at 14050, just a couple minutes ago. No, guys. There's really never anything that's expensive or cheap in the market. Right? It's just a new price that it's trading at. And just from personal experience, there'd be so many times that I would be looking to long ES off of, let's say, 45.83, sent an order in for 45.83, didn't get filled for whatever reason, sent it on the bid, whatever. And now the market moved kind of fast. Now it's at 45.85, right? So 2 points higher. And now I'm like, oh man, that's expensive now. I have to give up 2 points. And yeah, that's true. It would have been nice to get filled lower. But you should be looking at setups that aren't just going to fail off of 2 points, right? If your setup is not going to work out because of 2 points, guys, you probably should not have been taking that setup in the first place, right? I mean, you should be getting into trades where the potential point profit is like 20, 30 points, and you're scaling out along the way, maybe for just 10, but like potentially 20, 30 points, right? You shouldn't be getting into trades that are maximum, it has another 5 points of upside, and yeah, giving up half of your upside potential is a lot, right? So ignore the first info that you get, right? If you wake up and the price is at 4,200 and it opens, it's at 4,210, it does not mean that 4,200 or lower is a good price to buy. It does not mean that just because you saw it first at 4,200, it means now this is cheap, this is a good point to buy, whatever. Could end the day at 4,170, right? So 4,200 is not cheap in this scenario, right? There's been so many times that, I've been trading small caps and I woke up at 7 o'clock and ticker XYZ was at $4, and now at the open it's at 560, and it's like, oh man, I missed it. There's no more room for it to go up. I already missed $1.60 of delta on that stock. Oh man, I missed out. And then it goes to $8, right? So nothing is ever too cheap or too expensive, right? It's all just relative. The next one is confirmation bias, right? This is a tendency to look for info that confirms your own beliefs instead of looking at the other side and seeking for the truth, right? So in a trading example is you want to buy ES and hold for a swing because you want to make $1,000, right? You need that money so bad that you're ignoring the fact that ES has a low probability of going up. You're just looking at certain factors that look bullish for ES, right? You're looking at this indicator that says ES is going to go up. You're looking at this person on Twitter that says ES is going to go up. You're looking at some logarithmic chart that says ES looks like it's going to be bullish, but you're ignoring the fact that, the economy is not looking good. That, there's going to be news tomorrow and, that it's just not looking good, right? There's something else that's not looking good. There's something else that's not looking good, right? There's not a lot of bids that are popping into the market. So there's a lot more bearish signs than bullish. But you're just ignoring all of that because you just want to buy into ES and make that $1,000, right? And you need to play devil's advocate each time you trade, right? Why should I get in or out, right? Why should I buy ES right now, right? Yeah, you might feel FOMO on certain points, but let me look at the opposite side. Why shouldn't I get in right now? Oh, because this, and this is happening, right? When you're in the trade, look for reasons why you should get out, right? Don't just hope that it's going to go up when you're seeing the fact that, man, a big seller keeps coming into the market and pushing price down, right? This is just not looking good. The setup's not looking good. Oh, man, After 15 minutes, those candles all closed. That is not looking good. I would have wanted to see it go like this, but I'm already in the trade. I kind of want to, make some money. No. Be real, seek the truth, and if it's telling you to get out of the trade. The next one is hindsight bias, right? So this is a tendency to see past events as more predictable, right? So an example, you see a possible morning top reversal, but you don't trade it, right? You're too scared to enter it. Then 1 hour later, you see that setup worked out and you would have made lots of money. And you now think that you knew that it was going to happen. But guess what? Your predictions only count when real money is on the line. All right? It's easy to make predictions with no money at all. So many times I've looked at crypto or some other stock and yeah, the chart looks good, so I think it's going to go up. And then a week later, oh my God, it went up so much. Man, I missed out on so much money. No, you didn't, because if you actually knew, and if you knew and you were confident that it was going to go up, can guarantee you, you would have actually put real money on the line and bought in and actually caught that move. Right? It's really easy to see something that's down and be like, oh, it's probably going to go back up. And then it does. But if you didn't buy it, is completely irrelevant. It's like it didn't even happen. Right? Because it's so easy to just make predictions with no actual money on the line. Right? And no repercussions if you're wrong. And half the time you'll just ignore the fact that you're wrong on your wrong ones and only listen to your right hindsight biases. Right? So look to understand why the move actually happened underneath the hood. Right? So if Bitcoin went from 20K to 30K, right? Don't just say, oh man, I missed out, whatever, I didn't put any money in, I missed out. It looked good, but I didn't put any money in. Maybe it went up because, in this case, in today's day and age, the ETF approval, right? So maybe it went up because of that, right? So look to understand why stuff actually happens, right? Not just looking at the candles or the chart, whatever. Look for why stuff actually went up or down. Next topic here is bandwagon effect, right? This is following the crowd, right? So let's say, the Philadelphia Eagles football team is doing super good this year. They weren't last year, right? There's a ton of hype around them, right? A lot of hype, a lot of people following them now, right? That's bandwagon fans, right? Same thing in the markets, right? There's some stock, Tesla, for example, right? Ton of hype, a lot of Tesla investors, Tesla fanboys, right? A lot of Tesla bandwagoners, right? So that bandwagon effect is literally just following the crowd, right? The majority, what the majority is doing, right? Don't be a follower of the crowd blindly without knowing what's going on, right? Just because a lot of people, let's say when Tesla was going up like crazy, are making money, don't get in now just because other people are making money, other people are buying, right? Because then you buy, goes up and then down, right? And that's why you don't follow other people and you don't become a bandwagon trader, right? And follow what other people are doing because you'll just get smoked, right? So a trading example, if you're in a group chat and everyone's taking longs, it doesn't mean it's a good idea to go long, right? There's been times where I've gotten influenced to go long because everyone in the trading Discord was also going long, and then it doesn't go up, and everyone loses money, and I just literally lost $200, lost a trade, because I listened to other people and didn't actually do my analysis. It doesn't matter if I just lost the trade, even if I was with them. The point that makes it bad is if you don't do any research beforehand and you just get in just because and you're following blindly, right? Now, don't try to do the opposite of everyone on purpose every single time. Don't try to do the opposite every time on purpose, right? Over the last 10 years, right, there was people that were buying real estate, and there's other people that were saying, oh man, real estate's overvalued in 2015, 16, 17, 18, 19, 20, 21, 22, 23. And real estate kept going up and up and up and up and up. And there's people that, in 2017 said it was too expensive. There's too many people that are buying real estate. I'm going to wait till it crashes. And then it keeps going up and keeps going up and keeps going up. Right? So sometimes it's actually good to follow the crowd because there's an opportunity there. Right? But there's signs when there's too many people in there, and it's actually time to take the opposite side and get out, or go short or whatever, right? So that is the bandwagon effect. Now, my next point is endowment effect. And this is when we value something once we own it way more than before. Right? So let's say, right, a trading example, we want ES to get crushed and come down from 40.80 to our entry price at 40.50. But once it's at 40.50 and we get filled, now it's, fair value and it should go up. Right? So when ES is going up like crazy, it's rocketing like no tomorrow off the open. And you're like, man, if it could just come down to here, I would buy. And then it does, and it gets crushed, and you're like, yeah, come on, die, ES, die, go down. And then you get filled at 40.50. Now it's like, wait, hold on, no, don't go down. No, not now. Now it's perfect. Now it should go back up. It went down too much. And then whatever, might go down, might go up, who knows, right? Who knows? But the point is, just don't get attached to any position. Right? Be willing to sell like that. And in day trading and futures, yeah, it's a lot easier to not get attached because you don't really own anything. You're just trading the future. You don't own a stock or own a crypto or own real estate, whatever. Just don't get attached to any position. Right? And, I waited for so long to buy this. Now it's not looking good. Let me keep holding because, I want it to go up, and I think it's good to buy now, and then it goes down, right? So don't get attached to any positions. Recency effect. So this is a tendency to remember the most recently presented info the best, right? We tend to remember items at the end of the list the best, right? Because you just read them, right? The ones in the middle, not as much. The ones in the beginning, maybe. But if I tell you 10 things, you're probably going to remember the last 2 or 3, right? And remember, just because the trade setup failed one time before in the last trade does not mean that it'll keep failing every time. Trading is a game of probabilities, right? Just because the last time, whatever setup did not work out or you lost, does not mean that you're going to keep losing or that setup doesn't work, right? And if you're just looking at the last trade, right, only looking at one trade ago, then yeah, of course, you're going to get wary about longing a morning bottom reversal because it didn't work out the last time. But if you look at the last 50 times, that you longed a morning bottom reversal, and a good majority of those, 70% of those worked out, well, then you won't really care because that's going to be the average for the next 10 trades. So it doesn't really matter. But if you just look at, if you're really short-sighted and only look at the last trade, well, you're just not going to be with that S tier trading mindset. Loss aversion. So loss aversion showcases the pain of losing, is psychologically twice as powerful as the pleasure of gaining, right? When you gain something, it doesn't really matter, right? Like, it's nice, but you haven't really gotten anything, right? When you get, let's say, a pet, right? It's nice, but it's not everything, right? When you lose that pet, that is at least twice as powerful, right? Emotionally, than when you got it, right? And don't look at your P&L, right? If you see on your P&L that you were up $500 and now you're only up $300, you're not looking at the $300. You're looking at, oh my God, I just lost $200. And you have to disconnect from your losses and your profit and loss, right? That's why you have to take your P&L off the screen. Because if you're focused on the numbers, you're going to be completely missing what's going on the chart, right? Only look at what the chart is telling you, too, right? It's so much easier to just look at the chart instead of looking at your P&L and the chart, because then you're, getting biased off of your P&L. You see you're up 20, then 10, then 40, then 20, and or you're up 100, 120 at one point. Now you're down to 20. It's like, oh, I don't want to lose money now. It's just up 100 and you get out. Okay, if the chart is telling you that it's going to keep going up, then why would you get out just because maybe you're down a little bit? You have to let these trades work out, right? And a key point that I would recommend here is change your chart colors to non-green or red, right? Change them to black and blue or blue and gray or something that's not the standard green and red, right? Red, super powerful losing emotion. Green, super powerful gain emotion, right? When you see your P&L in red, you're like, wow, I lost. When you see it in green, you're like, that is money, I just won. When you see it in blue, it's like, oh, I made money. When you see it in black, yeah, I made money or lost money. Gray, made money or lost money. It can be either. Right? A loss will just have a parenthesis around it, right? And it's so nice when your chart is grayscale and not all colorful, because it makes you so much less emotional. So that's basically another tip, is set your chart or your computer colors on grayscale when you're trading. You can literally just go into the search bar right here and just search up grayscale and it'll take you to it, whatever, and then just switch it on to grayscale. It's really nice, guys. It's really nice. That is a key tip. I really don't see a lot of people talking about that or doing it. And it's like, honestly, such a hack. So now I want to get into emotional intelligence, right? This is the ability to manage your own emotions as well as others, right? To just know what's going on, how you're feeling, how other people are feeling, right? Emotionally intelligent traders are self-aware of their thoughts and emotions. They know when they're getting too angry at the chart for no reason. They know when they're getting really, really excited and are at the risk of taking a bad trade, right? Emotionally intelligent traders have a deep understanding of how they react in certain trading situations when emotions arise, right? If you get in long and the price tanks really fast, like you're down $500 in literally 20 seconds, and that's 2 times more than your daily loss limit, right? An emotionally intelligent trader would know, okay, this is not good, but I have to now stay strong. And if it keeps going down now, if it does not look like it's going to go up at all and bounce from here, then yeah, I'm out. And it sucks. I might not trade tomorrow, but this is just what happened. I could have not gotten in, but I did, right? Someone who's not emotionally intelligent would be like, oh my God, I'm down 2 times my daily loss limit. I don't know what's going on. Double down, keep buying. And just, go haywire and be at risk of blowing their entire account, right? And emotionally intelligent traders can manage themselves in turbulent trading times, right? Like when you go on a losing streak and keep losing and losing and losing, right? Or even, winning, 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 winning. Winning a bunch is almost worse than losing, because at least with losing, I mean, yeah, it sucks. Your confidence will get shaken, but if you're an emotionally intelligent trader, then you'll know that, okay, this is just all a learning experience. But when you keep gaining, 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 you're going to get so overconfident if you're not emotionally intelligent to realize, I am crushing it right now. Let me just take a step back. Let me go do something else. This is nice, but let me just try to reset. So many times I've seen myself and other people win so much, make so much, and then give all of it, half of it, more of it back because they just got so overconfident and they weren't able to manage their own emotions. Now, my last slide is thinking like a pro trader, right? How does a pro trader that makes 6, 7, 8 figures a year and has been doing it for the last decade or two, right? How does he or she think like a pro trader, right? So first off, the market is always right. You might want the market to go up when you're in a position. It doesn't. Guess what? The market is always right. That's what the market wanted to do. There was more sellers than buyers here. The market is always right. Okay, you're not right just because you think that you're right. Your opinion in trading is literally irrelevant. Could not matter any less. Even billion-dollar hedge funds, just because they buy does not mean that now they have to be right. Number 2, think in probabilities, right? Think in, okay, so over the last 100 trades that I've taken, this morning top reversal pattern has worked out 68% of the time. So this is a good pattern. Even though I lost my last 2, it doesn't really matter because 68% of the time, the majority, I should be out making money. So I will take this trade, right? Think in probabilities and accept risk. Number 3, trading is a risky business like anything, right? Why do you think that you would be able to make literally as much money as you want if you can take big enough position sizes and stay consistent? Basically a money printer, an ATM, and it's not going to have any risk or not be hard, an extremely hard learning curve. You don't think any of that's going to take place for something that is as amazing as this? Not having to have employees or manage payroll or a whole business or go out there. Can literally just sit inside and press some buttons, use your mind a little bit, and make a good amount of money. Yeah, it's going to have risk. Just be okay with that. Detach yourself from the money that you deposit. It's not yours anymore. Right? If you're lucky enough to get it back, cool. But whatever amount you put in, accept that could be gone. Especially at the beginning, it probably will be. Now, number 4, anything can happen. Just because the market has gone up 10% in a month, yes, does not mean that it can't go up another 10% and then another 10%, even in, let's say, bad economic times. Right? I see some stuff, right? Some cryptos that keep ripping like crazy. Solana, for example, is up like 4 times since its low last year in like really not good economic times, right? So anything can happen in the markets. It does not have to make sense, right? Number 5, my next point, execute trades with zero hesitation. This is something that I'm still working on, right? I still sometimes hesitate looking at the screen. Oh, it's not looking good. All right, I think it's looking good now. Okay, I'll buy. Wait, hold on. and I'll still be hesitating instead of just buy. See it, boom, I'm in. Not even thinking about anything else. So that is something that I'm still working on to get even better at. But I'm just saying that, executing trades with no hesitation will get you the best fill prices and will allow you to take better trades. Now, number 6, my last point. If you don't expect the market to make you a winner, then you should not be afraid to be wrong. Right? Same thing, kind of, that I said with number 3. Accepting the risk, right? If you deposit $5,000 in your trading account and you're expecting that is gone, that is to zero, it doesn't exist anymore, the market took it, then you shouldn't be afraid now to go lose trades because you already accepted that and you're expecting that's going to happen. So quite frankly, if you get out with 1,000 when you're beginning, then perfect, right? That's actually a great case scenario. You actually were able to walk away with $1,000, not zero, right? And if you don't have any expectations of making XYZ amount of money, right, then you should not be afraid to lose money, right? And especially as a beginner, the best case scenario is literally breaking even. You're telling me you can get a bunch of market experience for free, just some time do you have to dedicate, but you're not actually losing any money? That is winning. That is winning. If you're breaking even or even losing, not, your whole account, but 20, 40% in the first year or year and a half. If you can be like that and not lose everything multiple times, and yet you are winning, right? Everything at the beginning is just market tuition, right? You might have to pay $2,000 to learn how to trade, and now you can go make money, or 5,000 or 10,000 or maybe even more. But that's relatively cheap, right? If you make $10,000 in a month, right? You lost 10,000, you made 10,000. Well, now you're even, you're whole, and now you can, go on and make money with trading. So that brings me to the end of this presentation. Really hope that you guys enjoyed this. We are now 50 minutes deep, by far the longest slideshow and video that I've done. But guys, this is like one of the most important, if not the most important one, right? Psychology. This is the reason why most people cannot succeed in trading. It's not about the strategy or what broker you use or whatever. It's about how you think. How do you treat wins and losses? How do you manage your risk? Right? That's why people can't succeed. Because it's a super emotional game and they just cannot tough it out. Right? So once again, guys, just thank you guys for watching. I really appreciate it. If you guys could just go ahead and leave a like, comment, and subscribe, that would be awesome. Make sure you turn on that bell. There's only a few more videos left in this series, so if you're still watching, that is awesome. Kudos to you, and I'll see you guys in the next one. Peace.